Let's be real. Taxes can feel like a black hole that just keeps sucking away your hard earned money. But here's the thing, most people don't actually understand how tax brackets and tax rates work. And when you don't understand them, you could be giving away way more money to the IRS than you need to. I'm about to break down how tax brackets work and how smart tax planning can save you thousands. But first, let's clear up a common misconception. Tax brackets are progressive, meaning you're not paying the same rate for all of your income. So let's say for 2024 you made $150,000. You would fall into the 24th percentile tax bracket. But that doesn't mean that all $150,000 is being taxed at 24%. You only pay 24% on the income above $93,375. The rest of it is taxed at lower tax rates. So the first portion of your income is taxed at 10%, the next portion is taxed at 12%, and so on. That's why understanding how tax brackets work is key to ensuring that you don't overpay. Now, this is where smart tax planning comes in. Without a plan, you're at the mercy of the tax bracket. But with the right strategies, you can reduce your taxable income and even drop into a lower tax bracket. Let's say you're making $150,000 a year. By contributing to your 401k, using above the line deductions, or even leveraging things like the Augusta rule or bonus depreciation, you could lower your taxable income and avoid paying higher tax rates on extra income. Here's another thing people often get wrong. Your marginal tax rate is not the same thing as your effective tax rate. Your marginal tax rate is the rate that you get taxed on the last dollar that you earned. Meaning, if you made $150,000, that last dollar that allowed you to reach $150,000 is your marginal tax rate. But your effective tax rate is the average rate across all your income. So even though you might be in the 24th percent tax bracket, your effective rate could be much lower. Maybe even around 18%. Because the first portions of your income is taxed at lower rates. That's why tax planning is crucial. It helps you manage both your marginal and effective tax rates. The goal of tax planning is simple. Keep more of your hard-earned money in your pocket. And there are a ton of strategies you can do that you can use to do that. You can start by maxing out your retirement contributions, which reduces your taxable income. If you own a business, you can deduct business expenses, take advantage of Section 179 expensing to write off equipment purchases, or even you can utilize charitable contributions to lower your tax bill if you plan them right. The key is to be proactive. Don't wait until tax season to start thinking about how to use these strategies. Here's the thing. Tax planning isn't something that you do once a year when it's time to file. It's something you should be doing all year long. Waiting to the end of the year limits your options. But if you start now, you can take advantage of all the deductions, credits, and strategies that are available to you. Whether you're making six figures or more, planning ahead can save you thousands when tax time rolls around. If you're not thinking about your taxes now, you're already losing money. Follow my page to get more strategies on lowering your taxes and keeping more of what you've earned. Don't wait. Tax planning is the key to empowering your financial freedom. And it starts right now.